$88.28 is the official spot price for silver right now. $149.95 is what the United States Mint is charging for a single silver eagle coin. Same metal, same ounce. One price is what the exchanges say it costs. The other price is what you actually pay. When you try to own it, that gap is not a temporary premium. That gap is the system telling you something it does not want to say out loud. The paper price and the physical price have decoupled. I am going to show you exactly why 88 spot is a fiction no retail buyer can actually access right now, what the United States Mint sellout status tells us about true physical availability, and how the COMEX delivery crunch connects directly to what you are seeing on the shelves. I am also going to show you who profits from keeping the paper price suppressed while physical metal disappears, and what 3 specific scenarios play out from here with honest probabilities attached to each one. This channel exists because mainstream financial media covers silver the same way it covers everything else. They give you the number on the screen and nothing underneath it. CNBC gives you 88 spot. Nobody tells you the mint is sold out. Nobody mentions that 60% of all registered COMEX inventory has been called for delivery in a single month. That disconnect between what the exchange prints and what a citizen can actually buy is exactly the kind of structural signal this channel was built to explain. Not after it makes the front page, before. If you watched the thumbnail, saw that $61 gap between spot and mint price, and felt something was wrong before you could name it, you are in the right place. Drop COMEXOG in the comments, that is it, just so I know you are paying attention. $61.67 separates what the paper market says. Silver costs from what the government mint says it costs to own one. That is not noise, that is the story. The institution you need to understand today is not a single bank. It is the network of large commercial entities that hold concentrated short positions in COMEX silver futures. The CFTC commitments of traders' data has shown for years that the top for commercial short holders in silver futures routinely control positions representing hundreds of millions of ounces of paper silver. The documented playbook works like this. When sentiment turns bullish and retail money starts flowing into paper silver, the concentrated shorts dump large blocks of futures contracts during low liquidity windows, typically in the hours before the London Open or in the final 30 minutes of the New York session. Price drops. Stop. Losses trigger. Retail longs get wiped. The shorts cover at lower prices and book the spread. CME Group raised silver margin requirements from 15% to 18% recently. Official reason: leverage management. What actually happens when you raise margins is that small longs get squeezed out of their positions faster. Larger players with deeper capital absorb the margin call. Watch who is left standing after the margin hike settles. I am framing this as financial warfare education, not conspiracy. The CFTC has investigated silver market concentration multiple times. No findings of manipulation have been officially concluded. What is official is the position concentration data itself. Read the COT report. The concentration is there every single week, $88.28. That is the COMEX spot price as of March 11, 2026. That is the number every financial terminal on Earth is displaying right now. $149.95. That is the retail price for a 2026 Silver Eagle graded MS70. The United States Mint is currently showing not available / remind me status on the 2026 American Eagle 1-ounce silver proof, immediate sellouts. Generic silver rounds, the unbranded 1-ounce rounds that are the closest thing to pure spot priced physical, are trading at $3.50 to $5 over spot. So even the cheapest physical silver you can buy today is running $91 to $93 minimum on the street, the so-called official price. Of 88 spot is a number you can trade on paper but cannot actually redeem at a coin dealer or online retailer right now. Most people watching this have never seen these two numbers sitting next to each other before. So here is what it actually means in plain language. There is one official price for silver and a completely different price for silver you can hold in your hand. When the gap between those two prices is $60 and more, you are watching the paper system and the physical system separate in real time. What comes next is the structural reason that gap exists, and it has been building for months inside the COMEX vaults. The March 2026 delivery cycle, 10,526 contracts. Each contract represents 5,000 ounces. That is 52,630,000 ounces called for delivery in a single monthly cycle. Total registered silver inventory on the COMEX right now sits at approximately 86,100,000 ounces. Do the math, 52.6 million ounces called, 86.1 million ounces available in registered stock. That is 60% of every registered ounce on the exchange already spoken for. In March deliveries alone, the overall registered inventory has fallen 31% in recent months. Brink's warehouse posted a net adjustment of negative 740,429 ounces moving from registered to eligible on March 9th. That single adjustment removed metal from the deliverable pool. Eligible silver is metal stored in COMEX approved vaults that has not yet been designated for delivery. Registered is metal that has been warranted and made available. When metal moves from registered to eligible, it is being pulled back from the delivery pool. Watch the daily vault reports. The direction of those adjustments tells you what the warehouse owners think is coming. Total COMEX inventory across all categories is approximately 275 million ounces. Open interest sits at 2,847,392 contracts aggregated. Across all delivery months, the paper claims against that physical inventory are not small. Silver was officially added to the United States Critical Minerals list in late 2025 and early 2026. This is official government classification, not a market rumor, not an alternative finance narrative. What critical mineral designation means in practice is that industrial buyers, specifically in the electric vehicle and solar panel sectors, can now access federal stockpiling programs, procurement priority, and supply chain protections that were previously unavailable for silver. Government-linked procurement is now competing for the same physical ounces that regular industrial and investment buyers have always competed for. Some market watchers suggest this has already triggered front-running behavior among major EV and solar manufacturers, locking in forward contracts for physical silver before the full regulatory machinery kicks in. I cannot point to a single official confirmation of specific company actions. The pattern of industrial demand is real. The critical mineral designation makes the forward competition for physical supply structurally more intense than it was 12 months ago. PSLV, the Sprott Physical Silver Trust, holds 216,900,000 ounces as of March 10, 2026. PSLV is trading at a 4.5% discount to its net asset value. That discount is counterintuitive when physical is supposedly scarce. It tells you that institutional sellers are exiting paper exposure even while physical demand holds. Institutional money is selling paper silver vehicles. The same money is not selling physical. The discount on PSLV is not a signal that silver is less valuable. It is a signal that some funds are liquidating equity and paper exposure to cover margin calls elsewhere. The metal does not move. The paper does. SILJ, the Junior Silver Miners ETF, is down 2.59% in the last 48 hours and has fallen 14% from recent highs despite silver holding near $90 spot. Miners lagging the metal during a price hold is a classic signal of equity liquidation pressure. It is not a change in the underlying physical story. Gold is trading at $5,201.56, new record territory. The gold-to-silver ratio is currently 58.9:1. The historic average sits around 80:1. Ratio compression at this level means silver is outperforming gold on a relative basis. If that ratio compresses further toward the 40:1 range seen in 2011, you are looking at a very different silver price from where we sit today. The 10-year Treasury yield is rising, which historically pressures non-yielding assets like silver. The dollar index is stronger today. Both of those factors are working against silver in the short term. The fact that silver is holding above $87 despite both of those headwinds tells you something about what is underneath. The price right now. Federal Reserve reverse repo operations have drained from over $2 trillion in 2024 to approximately $320 billion today. When reverse repo drains to this level, the excess liquidity buffer that was absorbing market stress is gone. The Fed is now monitoring reserves plus reverse repo as a single metric to prevent a sudden repo market spike. That is a tighter, more fragile liquidity environment for all risk assets. Let me show you what could delay this, because honesty matters more than cheerleading. First, the dollar remains strong. A sustained dollar strengthening cycle caps commodity prices in dollar terms even when physical demand is structurally strong. If the DXY pushes materially higher from here, silver faces direct headwind regardless of delivery mechanics. Second, rising treasury yields increase the opportunity cost of holding non-yielding physical metal. If the 10-year moves above 5% and stays there, institutional allocation away from commodities could suppress price even against real physical scarcity. Third, the COMEX has options besides defaulting. They can and have in past stress periods offered cash settlement, adjusted delivery rules, and tapped emergency inventory from affiliated vaults. 52 million ounces of delivery notices does not automatically mean 52 million ounces change hands physically. None of those delay factors touch the underlying physical shortage. The U.S. Mint is not sold out because of dollar strength. Generic rounds are not trading at $5 over spot because of treasury yields. Industrial buyers locked into critical mineral procurement frameworks do not cancel orders because an algorithm ran the COMEX price down 3% in a Tuesday overnight session. Indian domestic silver is currently trading at the equivalent of $108.75 per ounce. That is a massive premium over London and New York spot. That is the real-time domestic market rate converted from rupee benchmarks. Eastern and domestic markets are already pricing physical scarcity directly. The Western paper price is the outlier, not the Indian or retail premium. Algos can manipulate the chop. They cannot manufacture new silver supply. Banks can run paper games. They cannot restock the U.S. Mint. Verify this data yourself. Pull the CME Daily Vault reports and check the registered inventory numbers and the eligible to registered adjustments. Look up the COMEX March 2026 delivery notices directly on the CME Group website. Check the U.S. Mint website for current availability status on the 2026 American Eagle Silver Proof. Pull the PSLV Daily NAV and compare it to the market price to verify the discount figure. Look up the Federal Reserve H4.1 balance sheet release and the overnight reverse repo operation data published by the New York Fed. The people who actually verify these sources realize this is not hype. The data is there. Every number cited today has a primary source behind it. Do the homework and you will understand what is building here without needing anyone to explain it after the fact. If you are a physical holder of silver, whether coins, rounds, or bars, the fundamentals have not changed. You hold the real thing. The paper price chop between 86 and 92 is noise around your position, not a structural threat to it. Watch the delivery data. Watch the registered drain. If you are trading silver futures, the margin hike from 15 to 18% was a direct pressure move on leveraged longs. Be aware that the same actors who ran price down from $97 on March 2nd can run it again. This is not a stable trending market. It is a volatile, contested market with real physical pressure. Building underneath engineered paper volatility, position sizing and stop discipline matter more right now than they have in months. If you hold PSLV or SLV, the current discount on PSLV tells you something. Institutional liquidation pressure exists in the paper vehicles even while physical holds. If you are in SLV specifically, understand that SLV holds allocated but not segregated silver and has authorized participant redemption mechanics that differ from PSLV. Know what you hold. If you are on the sidelines watching, the question you need to answer for yourself is whether the $60 gap between the paper price and the mint price is a temporary anomaly or a structural signal. I have shown you the data. The conclusion is yours to reach. This is education, not financial advice. Use your own brain. Scenario 1, bullish. The March delivery cycle forces physical delivery of a significant portion of the 52,630,000 ounces of outstanding notices. Registered inventory drops below 60 million ounces. Industrial front running under critical mineral designation accelerates. Price moves through $90 and targets $92.50 resistance. If that breaks, the projection range of $135 to $309 per ounce becomes a relevant framework. Not a certainty, a relevant framework. Probability, 35%. Scenario 2, neutral. The COMEX manages the delivery cycle through a combination of cash settlements and eligible to registered conversions. Price holds between $86 and $92 for the next 30 days. The paper-to-physical premium at retail persists but does not widen dramatically. Gold holds above $5,000, keeping the ratio below 65 to 1. Silver consolidates. Probability, 45%. Scenario 3, bearish. Dollar strength accelerates. Treasury yields push above 5%. Institutional liquidation of silver paper positions overwhelms physical demand signals. Price tests the $86 support and breaks toward $83.50. The 50-day moving average at $84 acts as a floor. Physical premiums remain elevated, but the paper price disconnect widens in the other direction. Probability, 20%. Everything covered here is for educational purposes only. This is not financial advice. Use your own brain. Do your own research. Always, physical will win. The only question is when. Invest with logic, not hype. Use your own brain. Don't follow anyone blindly.